Hello. Good afternoon, ladies and gentlemen. Thank you. Thank you all for coming. I'm really excited to see so many familiar faces, so many new faces in the room. My name is Takunda. I'm a second-year MBA student, and on behalf of the Business in Africa Club, thank you for coming and welcome to Navigating a New Global Trade Landscape talk. Basically, ladies and gentlemen, we are at a pivotal moment right now in terms of global trade. In exactly a week from now, the United States is going to propose or implement what are called retaliatory tariffs. So what does that mean for future leaders such as us who are going to enter into the working space? This demands not only just local expertise, this demands a global perspective. And hopefully by the end of this talk, we'll have planted some ideas in terms of how we should start thinking about tariffs going forward. So to help us with this conversation, we have two phenomenal members of the Fuqua community. We have Professor John Graham. He is our or at least the expert in terms of tariffs or finance in general. He's widely recognized as one of the most respected voices in corporate finance, having published extensively on capital structure, taxation, and financial strategy. In addition to being a long-standing leader in the academic finance world, Professor Graham currently leads the CFO Survey in collaboration with the U.S. Federal Reserve Banks of Richmond and Atlanta. Thank you, Professor. Round of applause. We're also joined by Stephen Fusi, a proud Fuqua MBA alumnus who currently serves as a Chief Brand Officer at the North Carolina Central University. He leads the university's efforts to shape a bold, future-facing brand and connect the next generation of learners and leaders. Stephen is also the founder of Posh Provisions, a snack food company operating in Cameroon, and co-managing member of HC86 Ventures, which is an angel investing consortium focused on technology businesses in Africa. Thank you, Stephen, for coming. Awesome. So the idea behind this is we want to make it an engaging conversation. So for the bulk of our time together, we're going to have about 15 minutes for Q&A. So as we go through Professor John Graham's presentation as well as Stephen's response to the presentation, please come up with your questions, write them down, memorize them, because for the rest of the conversation, we want you to also share your inputs and your thoughts. Does that sound good? Awesome. All right. Thank
you. All right. Thank you, Takunda. So I'm going to talk a little bit about the latest CFO survey, which has a big tariff element to it, as we'll see here in just a second. I'm not going to read all that, but we've been doing this survey for a long time. And what I'm going to talk about today are responses we get, and these are going to be for U.S. CFOs, okay? But I'll talk about how they're thinking about these tariffs, and we'll tie it into Africa towards the end. But as Takunda said, you know, the Q&A and the audience participation, I think we'll get a lot of rich comments tying this information to what's going on in Africa, how it affects countries in Africa. So here's an overview. This survey literally came out yesterday. This is U.S. CFOs. I'm going to give you a brief summary first. Optimism had increased following the presidential election. People thought President Trump would be pro-business. But that optimism has now fallen this quarter, the survey that just closed. In fact, it's lower than it was before the election now. So optimism fell. The GDP outlook has fallen also. It's still positive, but less positive than it was. And in particular, CFOs that are affected by tariffs are the ones most concerned about where the economy's heading. By far, the number one concern is tariffs. I'll show you some details, followed by concerns about inflation and interest rates and a few other things. Companies working to diversify the supply chains. And yet, even with all of that, there are a decent segment of firms that are still sort of hoping the dust will settle and we can have a normal-ish second half of the year. So that's the glass is half full part, that it's not like every company is worried directly about the tariffs. Okay, so let's talk about some of these results. Thanks to Larissa for helping format and put together this slide deck here. So this is from quarter 4, okay? And this is optimism in red for your own company, and in blue for the optimism of U.S. CFOs about the U.S. economy. And basically, following the election, the optimism jumped up. That's that little bit there at the end, okay? Before the election, the optimism was going to go up a little bit, but then it jumped up quite a bit more after the election, that little A up there, all right? Now, for context, this box here is the first time Donald Trump was president. Optimism kind of went up over a 2-year period and, stayed reasonably high. COVID did pull it back down, but even if you don't like Donald Trump, it's hard to blame him, COVID on him, right, type of thing. So COVID probably played a role in the reduction. But what are we seeing this quarter? Already the optimism has fallen kind of notably, okay? And so unlike the first time Donald Trump was president, there's a reduction in optimism already, probably in large parts of the tariffs and such, as we'll talk about. Now, to put it in context, it's not like the optimism fell all the way down here, okay? So really, the CFOs are not as pessimistic as consumer confidence index seems to be right now. So because, again, there seems to be a portion of CFOs that are saying, the U.S. economy's been pretty strong. This is not a good thing, but we're going to kind of trudge along at a slower rate of growth. Might be a way to summarize it. Large firms are doing better than small firms in this environment, both last quarter, this quarter, et cetera. All right, that's optimism. Here are the top concerns. Now, this is before the presidential election, kind of hard to remember back then, but what were the top concerns of CFOs? Labor, interest rates, inflation. But then the survey in the fourth quarter, a large part of it was after the election was completed, and I'm going to click that up now. Notice before the election, trade and tariffs were not really on the radar practically, even though there was a 50% chance Donald Trump was going to win. But let's see what happened after the election. We see the concern about tariffs jumped quite a lot, okay? In November, just after the election, it did not become the number one concern, because at that point in time, companies, I think a lot were just thinking, okay, there's a lot of talk about tariffs, but probably not going to really happen, and at least not very fast, sort of like the first time around when Donald Trump was president. And you do see concerns about interest rates and inflation sort of jumped up in November. Renzo, do you have a question? Okay. All right. Now, that's quarter 4. Let's look and see this quarter, the stuff that was just released yesterday. Keep your eye on the tariffs here. If you averaged the hashed line and the blue line there, that's about 8.3% of firms had said tariffs were an issue. That was the November result. Well, now we see in March, 31% of companies saying tariffs are the number one concern, and from 8.3 last quarter. And I mean, you can just trust me from experience, that's like the biggest jump we've ever seen for anything in any quarter. Even when interest rates, when inflation was high, et cetera, it didn't jump that much, okay? So this is a very large jump in concern. Number 2 now is inflation. Number 3, interest rates. But they are a distant second place, you might say, to what's going on with the tariffs. So another thing that came into play that wasn't even on the top 10 list at all in the fourth quarter is uncertainty, right? Uncertainty now jumped to be kind of in the thick of things too. Broadly speaking, like if they just implemented the tariffs in a predictable way with no uncertainty, that would be one thing. But there's a lot of uncertainty about it too, so you don't even really know what you're planning against, right? We're planning against high tariffs, low tariffs, medium tariffs, we don't know. So anyway, that's sort of a secondary thing perhaps, but it's playing and building and kind of magnifying the tariff effect, I guess. Okay, so let's now just using words instead of pictures. When companies list tariff as a top concern, those companies are expecting GDP growth, real GDP growth, so inflation adjusted, of about 1.3% compared to companies that don't list tariffs as a top concern, 2.3%. So, That's a full percentage point. I mean, that's a big drop, but it's not negative, right? So again, I'm just trying to keep a little bit of, I don't know if optimism is the word, but we're not necessarily predicting a recession yet. It's just we're going to trudge along is the current view. Maybe they're wrong. Maybe next quarter they'll be predicting a recession. We'll see. Right now, the CFO is concerned about tariffs, 22% chance of a recession, whereas those not concerned about tariffs, 13%. So again, it's worse, but not terribly worse, I guess you might say. 1/4 of firms say they're going to cut capital spending because of all the tariff activity. Of those that list tariffs as a top concern, 36% say they're going to reduce capital spending. That's a pretty big number, right? If 36% of this group is going to cut capital spending, that'll be measurable. And about 1/4 of all firms say they're going to hire less than they otherwise would have given the tariff activity. 75% are not saying that, but 25% saying it is, again, is an impact. Companies working to, again, diversify supply chain away from China. So that's kind of a verbal summary of where things are right now with respect to the outlook and the overall economy. All right, there's other elements of the survey, but I'm not going to get into them because we're focusing on the tariff stuff today. Yep. Yeah, they are. So let me go back. See this big line here, people concerned about tariffs? 36% of them say they're going to cut capital spending, and 25% of everybody says it. So I could have broken it down into those who say and those who don't say, but yeah. Okay, so hold on for 1 second, because when I was working on this earlier in January, I guess, or maybe even in December for something else, Takunda and Blessing put together some data that I'm going to show you here a little closer to Africa, right? And so in the Q&A, maybe we'll have a chance to talk on this. So what this shows here is this is the U.S. trade deficit relative to the continent of Africa, okay? And it was, a growing trade deficit, or in other words, from the African perspective, a trade surplus with the United States, right? Leading into Donald Trump's first time in office. That's what the gray box is. The surplus from the African perspective got much smaller, okay, during the four years of Donald Trump. Well, it changed again with COVID, but if you throw the COVID out, the trend was less of a trade surplus for Africa, less of a trade deficit for the U.S. relative to Africa. This is foreign direct investment, when the U.S. government or U.S. companies invest directly in the continent of Africa. And we can see that also fell during the first presidential term of Donald Trump, okay? Recovered a little bit during Joe Biden's term, but not so much. So the point here of showing you this historic data is, as far as we know, we might expect to see these trends happen again type of thing this time around. But again, I'm sure people in the audience probably have firsthand experiences. Another historic thing, when the U.S. put a 25% tariff on steel imports back in 2019, South Africa's share of U.S. iron and steel declined by 16%. So tariffs had a real effect, okay? And the last thing I'll mention about this historic stuff is the U.S. under Donald Trump likes to have these bilateral trade agreements rather than like NAFTA or some kind of a large group of countries. It's like a one-on-one thing, and and the U.S. is pushing for the America First, that we're going to negotiate, to our benefit sort of thing. And again, we would probably expect that to happen again. But Takunda and Blessing might have more to say if questions come up. So that's all I had. If you want to take over from here.
This is fantastic. Thank you very much, Professor, for sharing this. Where you ended on AGOA is where I will start.
Oh, okay.
I'll talk a bit about my business, which operates exclusively within Cameroon, and the company manufactured, I use past tense, snack food products to begin with, and now getting into cooking oil as a commodity product that's manufactured there. All of the products were made for domestic use, and so thinking about sending them outside of the country was a nice to have. It just so happens that this business started in 2018, and so around in 2020, just as we were considering how we might export the products to the U.S., Cameroon was removed from AGOA. It lost access to that market, tax-free imports to the U.S. Because of human rights violations, security violations in Cameroon. And so I went from thinking very heavily about how we could quickly scale up and trying to figure out what the trade routes would be like, how would we do the logistics to get products here in time to serve a market here, to forgetting about that altogether. Because once I weighed in what the duties would be to import here, it just didn't make any sense to try to do that at the scale we were at that time. Another point I'll make about the current environment with the tariffs that have been imposed now, and if I take it further to USAID going away and all the investment that's happened there, my take on it is that this is driving more African companies and some more progressive governments to consider how to do more intra-regional trade to take better advantage of the African Free Trade Agreement and make sure that you find ways to trade with your partners nearby. Cameroon borders Nigeria, very large market, and yet the products that if I went into a typical place in Cameroon, the products that I would find there, very few of those are from Nigeria, even though Nigeria manufactures many of the things that you might see as commodities being used there. Instead, you'll see lots of bootlegged diesel fuel and other things coming across the border informally. But what we're seeing now is more people are talking about why don't we have some more formal discussions about how to take advantage of this trade route, of this trade agreement, and do formal trading. And you can start to see in some countries, the progressive leaders are actually talking about that. This is not a new agreement. It's been in effect for, I want to say, close to 10 years through the African Union, but only now people are starting to talk about it in a more serious way. In terms of investors and their interest in going into Africa related to the tariffs, I'm not personally hearing too much of that as a concern. What I'm hearing more about is how are we going to take advantage of the idea that the U.S. may not be our key market to export certain things because of these tariffs, and just figure out how we're going to solve the domestic market and the market for our neighbors. It just so happens I was at the World Bank 3 weeks ago and in D.C. and had a conversation with some folks there about exactly this topic, that the investors the diasporan investors who are going to be the most likely to want to go into these markets that are highly risky, when you think about the U.S. not being a big potential partner, are going to be the people who have some kind of tie to that area. And so maybe if you are from the Congo, the Democratic Republic of Congo, this would be a good time to think about setting something up in that in that particular environment, because almost nobody else is going to want to do that at this point. Lots of active fighting is happening there, great instability with the government, incursions from other countries seem to be happening. And yet, if you have some kind of emotional tie, there seems like there could be some institutional support for investors for diaspora investors from that area to want to get in there. And you could multiply that by other countries that are facing similar types of situations. And so, to wrap up my take on what the tariffs impact is, I'm not personally hearing about that too much. It's not really a part of my business. It's not a direct concern for us, because we're serving a domestic market at this point. And what I'm hearing from similar operators is they're happy for what seems to be some more governmental interest in reinvesting domestically to improve their own businesses locally. So that's my take on it, and happy to have more discussions.
Thank you.
Oh, he's going to stand here? Okay. Here, I'll get the chair.
Awesome. Well, I'm sure we all have questions. I know I do. I'm going to just start off with you, Professor John Graham. You kind of talked about the downside of tariffs. I'm curious, is there a bullish case where you see tariffs actually panning out positively for not only the US, but the global trade landscape?
It's hard to make the case. I suppose you could say there will be some companies and some sectors that could benefit, say, in the US, but I see Alex out there. We had a similar conversation yesterday in a different setting. If tariffs kind of add a friction into the economy, and the friction kind of reduces the size of the pie, if you will. And so maybe you have a smaller pie that some sectors can still benefit from, but it's hard to say an overall win scenario when you have more friction than a kind of a smaller pie, if you will. I suppose, I mean, whatever, we could spin a few stories here and there, and you could argue that maybe within the continent of Africa there'll be more trading amongst countries, and that could be a really good thing in the long run, right? Yeah. And that sort of thing. But in the short run, you're losing a big market to the U.S., or the prices are going up at least, et cetera. It's hard to spin too great of a story, to be honest. Yeah.
Got it. For Stephen, I'm curious, have you ever tried to raise capital in the U.S. and deploy it back in Africa? Is that something that you have explored before in your ventures?
I've explored it through angel investing, and for my own business, not in a serious way where I was going around pitching people and soliciting investors. I've had many people approach me about investing in the business to help us to scale up, and I prefer to do more take a bootstrapping approach, precisely because, it's maybe counterintuitive, because it's so risky to do this, that maybe I have a bit of ethics on my mind. I should divorce the two. I'm thinking, wow, this is so risky. I'm not really sure, could I get you your money back yet? It's still too early in what we're trying to do, and we're able to operate through our free cash flow, what we're doing with the business. We're selling products. We have things that work. People seem to be enjoying that. And so I thought I would pause and do fundraising once we got to a point where there's just no other way to make it happen, and let someone else take some of that risk.
And just a quick follow-up on that one. If you were to raise capital, would you raise it back home in Africa, or how would you fund operations typically? What
I have found is that the people who have been most amenable to investing are people in the diaspora. They may have more disposable income. I'm not sure that's really it, because there's lots of disposable income in Africa. Definitely more of a risk tolerance, because if you're in the West, in the U.S., or you are in the U.K. or France or somewhere like this, particularly in the U.S., though, you're surrounded by people who are doing entrepreneurial things and raising money, using other people's money, debt financing of all sorts of things, venture capital, all that stuff is all around you. So it's not so much of a stretch to say, why don't I participate in that as an angel, join a consortium, etc., versus people who are in country, aren't exposed to that so much, and what they're really thinking about, this is a generalization, please, really thinking about, if I put this money in today, tell me the exact rate of return you're going to give me on this very risky venture, and when exactly I'm going to get that money back, which is exactly what you can't say if you're raising venture funding of any kind. You couldn't say, a year and a half from now, for sure, we will have grown this far, and I'll give you this exact premium for you putting the money in. So the conversations would usually stop there once you tell that truth. So that's what I have found. If I were doing it, I would focus on people who are in the U.S.
Do you have any questions? Yes, please, Tijani. Can you please speak in the mic because you're recording? Yeah.
Okay, good afternoon. Thank you, Professor. Thank you both for the presentation. If you could go back to slide number 10. The reason why something jumped out at me at slide number 10. No, I think one more. Yes. You said the biggest concern there is trade and tariff. It doubled. Well, it's a big jump from 8.3 to 30.5%. But also concerning is if you look at labor quality / availability, it says that in Q4 of last year, it was 23.2% of a concern, but now it's almost a 40% drop at 14.5% as a concern. It's almost seemed paradoxical compared to the environment that we live in now with immigration saying that it's less of a concern.
Very good observation. So just let me tell you about the nature of the question. It's literally a blank line, and we say write in whatever your concerns are. They could write in one thing, they could write in 5 things. Most companies write in about 2, and so just human nature kind of thing. If you write in tariffs, maybe you stop writing in labor or something like that. So it kind of crowded out, I think, some of the other numbers. So that's the way I would sort of interpret. Don't kind of interpret this as quite as literally here, because this thing here is kind of forcing a lot of the others kind of smaller. Admittedly, it makes it a little squishy to interpret that, but that's part of what I think is going on there. Yeah, good observation. Well, let me just clarify one last thing, or maybe I want to get a little more precise on your question. So let's say there's a tariff put up and it protects a certain U.S. industry, right? It's possible that there will be more workers in that U.S. industry employed in the U.S. That would be a win, from the U.S.'s perspective. But the tariff might push up prices also, right? And then everybody who buys the product pays a higher price. So it's not that the job came for free. There might be some people in some industries that benefit. If everyone's paying a higher price, you're just sort of spreading out the cost of providing those extra jobs. And if you added it all up, that's the sense that you kind of lose value from this friction, is what I meant to say. Does that make sense?
That makes sense. And from what I've been hearing, at least, I think the position from the Trump administration is that the pain is transitory. It's just going to hurt a little while before, things get better in the long run. I'm not sure your view.
I mean, that story would be that in 5 years or however long, we've got all these robust manufacturing industries back in the U.S., and that generates its own good value and such. But again, just the usual economic way to think about it is trade actually increases wealth and benefits for everybody on both sides of the trade. And taking away trade, again, usually the usual way to think about it is it shrinks the pie. Maybe they're onto something, and we'll find, and we'll be proven wrong. But that's not the usual way to think of it. Let's put it that way.
Awesome.
Thanks. Hi, I'm Benedict, a first-year MBA, and I have a startup in the fintech AI space. And actually, one of our first clients is this recorded, or is it just it's from a country in Africa, and we also work with some folks there. And what's striking to me is just how ridiculously hard it is to transact, for example, with like the local currency, and then you need to set up technically a subsidiary in that country, but it can't be majority owned by foreigners and so on. And it just seems like a pretty self-imposed challenges there from like a protectionist perspective. And at the same time, on the global stage, the US seems to be pulling back. China has the whole Belt and Road Initiative. Europe, where I'm from, is now waking up. So I'm kind of wondering, what do you think is like the next 3-5 years in Africa going to look like in terms of opening up to Europe, maybe also to China? How is it is FDI going to rise from those countries, and are there going to be improvements, or is there still going to be a lot of internal conflict, a lot of protectionism, and so on and so forth?
Well, I'll give my take on that. It seems to me that as some of the old guard leadership in Africa ages out or leaves office, that some of the younger leadership there is actively reimagining what is in their country's best interest. You can take the case of Burkina Faso, for example, and their leader, Captain Traoré, I believe his name is, took over in 2022 or 23. Second coup in a few months' time, and he has been doing all sorts of things, meeting with Russia, not meeting with France in the way that they used to do, engaging with the countries that are nearby. They formed a separate economic community outside of ECOWAS, which is the main one there in West Africa. And they're doing things like putting in better production and setting up factories, all sorts of things like that. I imagine that more people are going to be inspired by that kind of an example. The younger population will demand that, especially as this old guard of leadership that's been around since the pre-colonial days ages out and leaves office. And so you'll get, I don't see a whole lot more exploitative or extractive trade with Europe, because the terms are not as good as what you might get from China. China, for example, would come and say, I don't care at all about your internal politics. I want this particular thing, and I want to pay this much for it, and you negotiate with them about that with no other strings attached as far as what you do, how you manage your country's policies. But they will put in things about use Chinese companies, use this. I can see that more African leaders will say, well, we need to do the same thing you all did in the 70s and 80s with tech transfer, so that we're not getting all this old equipment in our country. We're getting the new stuff, and our citizens are the ones operating it, so we can learn something and build up our industry. I see more of that happening. The United States seems to have just taken itself off the playing field in terms of forging deeper agreements with folks and playing in a way that would be more beneficial to the U.S. and ceded ground to China and even Russia and probably a few others that are in there actively doing things. And I'll wrap also by saying that in all these cases, there's a lot of very active and imaginative propaganda happening from a multitude of places. And so to the extent that the war for attention is won by one or more of those players, if it happens not to be the U.S., I think those players will be the ones who will be influencing those local government policies to do things, which would mean probably wouldn't be Europe and probably wouldn't be the U.S. if things go the way they're going right now.
Awesome. I think we still have time for maybe 2 more questions.
Hi, my name is Mary Mitchell, and I'm a first-year and last-year student. I'm doing the MMS program here at Fuqua. And my question is probably more for, is it Stephen or Stephen?
Stephen, yes.
Stephen,
Thanks
okay,
for asking.
awesome, yes. How do you think that, so marketing, as we know, is pretty important in terms of the success of a business. How do you think that that will play a role in shaping the way that these concerns impact the future of businesses?
How would marketing shape in the context of these concerns about tariffs, how would that shape the future of businesses? My goodness. I'd say that, let me ask a clarified question to you. From whose point of view are we answering this or addressing this? From the point of view of the African countries, from the point of view of the U.S., or the point of view of investors? Who are you? What are you? Maybe clarify that for me a bit.
Yeah, I think I was thinking more about marketing to the consumer and then how that will impact the way that businesses then view the concerns.
Okay, well, I'd say to the extent that consumers understand the impact of the tariffs, meaning higher prices for them, that they're paying those higher prices, and that the businesses are, well, they're passing those along as a matter of how to, stay in business, and that they would, maybe they're reinvesting in some kind of way to be able to better serve the consumers. I mean, I'm not exactly sure how a company would navigate the impact, which is higher prices, is what the consumer sees, and does the consumer really care about why those higher prices, as far as the business is concerned? I'm not sure. And should a company be in the, well, maybe they should, to their shareholders maybe, and maybe to the extent that you can do a direct map, a car company, for example, here saying that the prices are going up now because of tariffs. So it's not our fault, it's the government's fault. But how can those companies continue to say that when they might be needing the government for other things later on? They're really in a pickle on marketing that to the consumer. And so, this is a long non-answer, because I don't know. I don't know how you would actually do that from a company's point of view. So shareholders, for sure, you'd say that, sales have gone down because prices are up because of the tariffs, and that's why our share prices might drop, but stick with us. To the consumer, they just care that the prices went up, and how long are you going to be able to just keep blaming that on the tariffs? I'm not sure if it's effective.
Awesome. Do we have, yes, David?
Thank you very much. My name is Daniel, first year. I'm curious to know, as somebody who is passionate about entrepreneurship and building businesses in Africa, I'm curious to know, and I hear you talk about the fact that the old guard leadership needs to change and all of that, but while we wait for all of that to happen, I see all of these concerns, what would you say needs to change from the perspective of African business leaders? What do you think they need to do differently in order to tip the balance when it comes to that imbalance in trade and stuff like that? And this question could go to any of you. Thank you.
Would you like to take it? Okay. Well, this goes to the question I was asked earlier about, did I seek any investors? Businesses in Africa would have to add more value. Like if you take their local government off the table and assume that the local government is not going to do anything to create an environment that's fertile for development, that means then you, the entrepreneur, have to figure out how to do that. You have to build your own spaces. You have to put in your own roads. I mean, think about the oil refinery that Dangote built there in Nigeria. He had to put in his own electrical power plants and put in his own roads, build his own ports. This is the thing you would think the government of Nigeria would have done to facilitate having a big refinery, but they did not. So he did it. And I think on a smaller scale, like that's many billions of dollars. So if you're talking smaller scale, entrepreneurs would need to do the same sort of thing. Find very risk tolerant and long-term patient investors to help you to invest in the infrastructure that's needed to be operating at scale, and then create more value to the assets that you have on the ground. You have all of the raw materials there that you need. Other countries are coming to your country to get them, to go process other places and bring back to you. The entrepreneurs would need to invest deliberately in made-in local country marketing efforts to get the population to start to switch even at a higher cost, which is very difficult in places where you have such a bifurcation of standards of living. You have very few people who are very, very rich and a whole lot of people who are very poor, and the middle class is growing, but it's not like middle class here. So you have to convince people who don't have that much to get the scale to buy locally. You definitely have to get the people who can afford it to buy locally, get more of them to support. So I would say find investors or locally or outside who can invest in the infrastructure so that you can build value-added products that you don't have to, so you can do import replacement, and then invest in changing the hearts and minds of your consumer base, including corporate customers, to spend locally so that this starts to create a flywheel for you.
Ayo, that would be the last question because we do have to get back to class at 45.
No problem. Thank you. Ayo, second year. So probably a two-parter question just to round up. So in terms of trade war, you kind of spoke earlier about it being essentially for protectionism. So I was wondering, in terms of actually using it for protectionism, you spoke about like a stepped-up approach of like sequentially increasing trade barriers. How would you actually expect the country to effectively actually run a trade war program to end up in a trade deal, just generally? And then for Stephen, you kind of spoke about when you initially wanted to think about exporting, you immediately looked at AGOA. Were there any other African countries that you considered, and what were like the biggest trade barriers you saw when you were considering those other options? Thank you.
If I understood your question, I think the first thing you do if you were trying to work out a bilateral agreement with the U.S., compliment Donald Trump a lot. Just say, tell him how great he is. That's the first step. But you have to be offering what the U.S. wants to hear, right? And then, you ask what you want to get back out of it. But there's going to be certain minerals and certain products that the U.S. views as very important. If you're producing or selling one of those, you probably have a little bit of negotiating power that, if the U.S. thinks they're getting what they want out of it, sort of thing, then you can negotiate from that strength, I guess I would say.
We considered exporting to Nigeria and to Ghana, and this was around 2020, and we found that we were not price competitive yet. We were still in a scaling mode, and our cost of goods was pretty high and going higher. And so it wasn't until later that we started to reverse the trend to start to be able to make our product more cheaply or less expensive. And so I didn't see a pathway that if we sent our products across the border to Nigeria that the market would even adopt them. And it's not like there aren't Nigerian brands of potato chips and other such snacks. There's plenty. And I didn't see what our uniqueness was going to be in order to overcome that price challenge. And then there was the logistics of it all, too. Where my factory is located, there is only a dirt road, believe it or not, from this major city that goes into Nigeria. Eventually, you get onto dirt roads that are poorly maintained. People run those roads all the time, but it's expensive to do it. And so once I didn't see a really good marketing strategy, and I investigated the logistics, and it was challenging, I just dropped it. We would send some things on a case-by-case basis. Somebody would want something, we'd ship it there or to Ghana, but nothing serious.
Awesome. I'll be remiss if I didn't ask you, Professor John Graham, what does it look like for monetary policy? I know you highlighted it as a big issue as well. Is the Fed likely to cut interest rates in May or maintain? What do you think?
I doubt it. If we enter a recession, then they'll be tempted to cut them. But in the meantime, the inflation worry is looming, and so I think they won't probably cut rates anytime soon.
Interesting. Well, thank you very much, everyone. I'll just pass it on to our president for the Business in Africa Club to just give off some closing remarks.
Thank you so much for attending. Thank you, Professor Graham. Thank you, Stefan, for the wonderful insights. Just a couple of announcements. Next week, BIA is having the Taste of Africa event, and I'm sure you've seen the flyers and the link going around. You could purchase tickets to attend. It's $10 for 10 different meals. Come experience Africa, not the non-financial part of Africa. And then a week after that, we'll also be having our Afrobeats party. You could also come experience Africa, this time the music part of Africa, and we'll be looking forward to have you all attend. It's a good time to come socialize, network, and also, get some of the academic work off your shoulders. All right, thank you so much for showing up. We're glad you made it.